Hey y'all, Chad Kirkpatrick here, and in this video I'm going to talk about my investment strategy for this house. I will have a future video that goes into a lot of detail about it, but for now I just want to give you a high-level overview of what my criteria was for buying it and what I hope to be for the total return to be in the next 5 to 10 years. If you're familiar with the concept of waterfall investing, or as Ken McElroy calls it, infinite returns, this will make a lot of sense to you. If not, I think you're going to be very excited about how it works out. It's important to note that before you buy any property, there are two things that I want you to keep in mind. First of all, is that investment you're making, does it fit into your why? In other words, does it match your long-term personal and business goals? The second thing that is very important before going searching for an investment property is, do you have criteria to buy that is both specific and measurable, meaning you know what you're looking for. So in my case, my entrance criteria is that the gross revenue has to be a certain percentage of the sales price, and that the cap rate needs to be above a certain percentage. My numbers for both of those are that I can project 15 to 20% of revenue, 15 to 20% of my sales price, and then an 8% or greater cap rate. And later, again, in the later video, I'll talk about how I come up with that projected revenue and how we estimate those cap rates. But for now, those are the numbers I like to use. In the case of this house, I paid $1 million for it. So I would be looking to get anywhere from $150,000 to $200,000 in gross revenue every year. And also at an 8% cap rate, a cap rate is simply our return on investment, I would be looking to make $80,000. And that is, of course, $80,000 before a debt payment, and a debt payment can be a very large number. So that criteria was met, so I bought the house. And the great thing about that is every month I will collect a rent check of that amount, so it's a nice stable income year over year. However, it gets better. For those of you who have owned real estate for 5 years or more, you've watched the value in your real estate to go up. Now, there's no guarantee that your real estate will always go up, but over a long period of time, 5 years to 10 years, chances are you're going to make money on your real estate. And in this case, I'm projecting in the next 5 years that this house will appreciate in value by 30 to 50%. So in other words, if I have $1 million house today in 2021, by 2026, it will be worth $1.3 million to $1.5 million. So that is great news, right? So that's an increase in value. It means I've made money on my asset, but does it really put money in my pocket? And this always leaves investors with a big question mark. I've got all this money in my house. How can I tap into it? Because I cannot raise the rents to match the new value. I can only raise the rents to what people are willing to pay in the market. Investors will typically do one of two things. More novices, a lot of times, will usually just sell the property. Let's just use the more conservative example that the property is now worth $1.3 million after 5 years. They will sell the property and collect $300,000 and say, I'm a smart investor, I made $300,000. And they are a smart investor because they made $300,000. But there's two problems with that. The first one is when you sell the house, unless it's your primary residence, now you have a taxable event. So yes, you have to pay taxes on $300,000. The second thing that happens is you lose your income stream. So your cash flow now comes down based on that rent you were collecting. So that leaves us a quandary. How can we get around all of this? Well, I think a lot of you have heard of the concept of a cash out refinance. That's where we do it a lot of times in our own personal home. We do a refinance and hopefully lower the rate and extend the term out. Well, we can do the same concept, except now we can use it with the term cash out as part of the refi. The cash out piece allows us to grab that equity. So in this case, I've got a $1.3 million house in 5 years from now. I'll talk to my mortgage broker who will help me do a cash out refi. Depending on what the interest rates are, the interest rates might be higher in 5 years, they might be lower in 5 years. That could change my monthly payment, but they will give me a mortgage based on that $1.3 million, but only have to pay out the $1 million that I owe on the loan. That leaves with an excess of $300,000, which comes directly to me. Now, there are two fantastic advantages of doing this. Okay, well, three. The first one is I get to keep the house, right? When I get to keep the house, I get to keep the cash flow, which means I have this long-term income stream that will go on and on and on for as long as I own the house. I do not lose that, but I also get the increased equity. So that $300,000, not only do I get it, but it's tax-free because it's not income. I'm just refinancing debt. So I don't have to pay taxes on it. So from an exit strategy perspective, I'm not really exiting, but in 5 years from now, I do hope that it will have increased in value $300,000 to $500,000. So in addition to collecting an annual rental amount, and let's just say the rental amount was $10,000, over 5 years, I've collected $50,000 in total rent. Then I do a cash out refi. I get $300,000 back, tax-free. In other words, my total investment has given me $350,000 in income over a 5-year period. And that is a great return on investment. And not only that, in 5 years afterwards, I can do it again. So in 10 years, I can collect $700,000 or more from this house. So that is my investment strategy, and I hope as you go out and look at your deals, make sure the deals fit your long-term goals and vision, make sure you have strict entrance criteria for why you're going to buy it, and do not sell your real estate. Maintain it and continue to create this infinite returns with them.